Alright, so I'm really excited to share this video with you because I want to show you my 7 best performing stocks for passive income that I've purchased through the Robinhood trading app since I've started investing. But first, I want to show you exactly how I look for my stocks. Let's go take a look. So the first thing I look for is a company with a very light balance sheet, like this. So light that it just floats up and makes my money worth more. But the second thing I look for is a company with a good float, which is the number of shares that I can buy, like this. Woo. And that's all the market forces at work right there. No, I'm just kidding. That does not at all explain how market forces work or even how I look for stocks, but it does perfectly describe how I feel on the inside when I get paid passive dividends. But whatever you do, don't play that part back in slow motion, otherwise you will see all the invisible strings that made all that possible. Just kidding. That's not at all how it works. Let's begin. My name is Andrei Jikh, and today's video is brought to you by keywords: Robinhood, stock market, dividends, passive income, and all the other keywords that made this channel an accidental success. But today's video, I wanted to contribute and bless the algorithm gods so that hopefully they can return the blessings on thy channel, and hopefully we can reach 1 million subscribers by the end of this century. So let's invoke thy algorithm and bring together Robinhood, along with dividends, and of course passive income, and fuse them all together to bring to you the ultimate clickbait dragon. In addition to showing you my 7 best performing stocks, please take note of the Morningstar rating system from 1 to 5. 1 being it's expensive to buy the stock right now, so maybe don't buy it. 5 stars meaning it's pretty cheap, so consider investing, and 3 is fair value, which for great companies, not a bad time to invest in either. Ultimately, I'm not here to sell you a course on stock market investing. This is just something I do for fun, for transparency. I hope this helps you out, and in the meantime, smash the like button and subscribe so I can feed my kid. Remember that Titanic scene? I've got a child! But if you're brand new to dividend investing, let me visually show you, because I'm a visual learner, exactly how dividends work. So imagine you're investing in a company like Apple, and quarterly, it pays you. And wouldn't you know it, you've got some money. And every quarter, it's worth less by the same amount that it paid you. But that's actually not always the case, because the stock price can actually just recover and nothing happens. I'm really sorry if you've already seen that trick, but I worked really hard on it, and I think it's super analogous to dividends. And my last video didn't do too well, so I don't think anybody saw it. So here it was again. But now let me show you my best performing stocks in my Robinhood account in the last 5 years. Starting off with number 7 is Hormel Foods. Probably a company you've never heard of before, but I guarantee you that you've bought something of theirs in the past. This stock has grown 47% for me, and that represents just 0.3% of my investing portfolio, which means at some point I would like to buy more. And here's how I know whether or not I should buy more of any given stock. I try to own anywhere between 1 to 5% in my portfolio, but never more than 10% in terms of the actual value in relation to my entire portfolio or the amount of income that it pays me per year. So for example, if I know that I wanted to have a portfolio of 20 stocks, I know that each one, if I wanted them to be even, should be no more than about 5%. But you can take the number 100 and divide it by the amount of stocks that you ultimately want to end up owning. So for example, if I just want a portfolio of 10 stocks, then I can divide 100 by 10, which gives me 10%. Now, Hormel Foods right now is paying me 2% per year, but usually I try to aim for 4%. Now, the reason that I own them, even though they're not 4%, is because they have a double-digit growth rate for their dividend at 11% per year. And for the long term, if they can sustain that, that'll eventually reach me to the 4% mark at some point or another, which is good. But more importantly, their dividend safety score is rated at 99 out of 100, which is amazing. And the thing I prioritize most right now is safety, 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 because I don't want to lose money. Who would have thunk it? Coming in at number 6 is Johnson & Johnson, which is a pharmaceutical giant, and it makes up about 6% of my portfolio, which is a very large position considering how many stocks I own. Now, Johnson & Johnson has recently increased their dividend in May by 6%. That marks the 58th year in a row that they have increased dividends, and that is incredible because it shows stability and it gives me a peace of mind in a world that is so uncertain. And one of the coolest things about Johnson & Johnson is that they have a dividend safety score score of 99, which is one of the highest, if not the highest, that you can see. And part of the reason for that is because their payout ratio is so modest right now, which gives them room for growth in the future. In addition to that, it's also the reason why the price has appreciated 50.3% for me in the last 5 years, which is really cool. Unfortunately, in terms of the price itself, it's rated at a 2 stars. It's a relatively expensive stock to buy right now, but I'm constantly watching the price and hoping to buy more. And coming in at number 5 is UNP, Union Pacific, a railroad company which, just like Monopoly, you have to own this piece of 32,000 miles of railroad track that has increased 61.6% in the last 5 years alone. Believe it or not, I own this paper version of Union Pacific from 1982. Look at the price. $250 in comparison to today's $170. You would have multiplied your money nearly 70 times if you had started investing back then. And that's just price appreciation alone, not counting dividends, which right now is about 2.28% dividend yield, which is not that bad, but a 14% growth rate in the last 5 years and an 88 dividend safety score, which is one of my goodest boys. And coming in at number 4 is ticker symbol LIN, which is LINN. Now, since I started investing, it has grown 67.2%. Now, LINN makes and transports natural gas. As far as LINN is concerned, they've increased their dividend 28 years in a row, which is amazing, but it'll be interesting to see if they can continue this throughout the economic distress. But if I had to bet my money, I will say yes, they will continue those dividend increases because they have a safety score of 99, which means there's plenty of room to growth because of their low payout ratio. And if you're looking for modest growth and modest income, then LINN is one of my best performers. And coming in at number 3 is Grainger, which has everything to do with creating, maintaining, and repairing tools. No, not those kind of tools. I have no idea. I'm just a creator who likes to stay more relevant by riding the coattails of more successful YouTubers than myself. This stock has grown a massive 70.37% since I've started investing in it. It's got a very healthy balance sheet with only a 33% payout ratio. Now, the standard payout ratio that most investors look for is around 60%. So the fact that this is basically half at 33% means there's a lot of room for growing the current 1.86% dividend yield per year. But the fact that they've been paying for over 48 straight years shows the kind of commitment that every man should aspire to have. They've also got a safety score of 99, which is incredible, and I love me some Grainger. A real pureblood, this one. NSC is another railroad company with almost 20,000 miles of railroad transporting goods with 18 years of continuous dividend increases. This company has increased 85.7% since I invested, almost doubling my money. It's also got an incredibly low 47% modest payout ratio, along with a 2.1% dividend yield, but its growth in the last year has been 18%, which is double-digit growth rate, which is exactly what you do want to see when you're investing in a company that has a low 2% dividend yield. You want to see that dividend yield increase over time, which is also why it's got a whopping dividend safety score of 86. And coming in at number 1, the best overall stock that I've ever purchased is coming from the largest fruit company in the world. Literally, Apple. Apple has grown 178% for me since I've started investing, which is insane. I wish I could go back into the past and buy more, but the best part about Apple is that their dividend safety score is, much like every other company on this list, is 99, which is the highest you can have, and that's due to the fact that they have so much money. Cash up to the just so much. But the downside to investing in the tech sector is that their dividend yields are usually very low or just non-existent. But the great thing about Apple is that they get a good mix of dividend growth along with insane price appreciation, so you get the best of both worlds, and that's why I love owning it. But that begs the question that I used to ask myself as a beginner investor, which is, Andrei, why don't you put all of your money into your first best stock? Because our second best idea will never be as good as our first best idea. So here's the answer to that. The reason we don't do that is because we take an asymmetric risk and we're exposed to things beyond our control all the time as investors. Things like fraud, tax accounting errors, things like regulation. We just can't control those things. And if one of those things goes wrong in 1 year, that stock price can tank and the company can just vanish overnight. Now, that's unlikely to happen to Apple, but there are some risks that you take as an investor that you don't want to take by putting all of your eggs into one basket. So no matter how good a stock looks on the balance sheet, you don't want to put all of your money into it. Now, in the case of Apple and most tech stocks, right now it's a 2-star stock, which means it's relatively relatively expensive despite everything else going on in the market, but if you ever find Apple at 3 stars or a fair value price, jump on that and I'm gonna be buying more as well. Now, I'm not saying you should buy all of these stocks right now, but I'm gonna be paying attention to their price, especially how volatile the stock market is going to be. And I think there's gonna be some opportunities, and I think every passive income investor should own these stocks. But having said that, I do love to practice what I preach, which is why I like to dollar cost average no matter what's going on. And right now I'm being very conservative with investing, which is why I'm only putting in around $2,500 per month, which I realize to most people is a lot of money, and to me that is a lot of money too, but considering my income, it's very conservative, but it's also the same exact amount that I was investing when I was earning $50,000 per year after taxes, which I realize is very difficult to do, and you have to be very frugal, but if you can do it, I know it's possible, then you'll do very well for yourself. So here's my crystal ball prediction stab at the stock market. In the short term, I think stock prices will go higher because of something called pent-up demand, which is just a fancy way of saying that our money is just burning a hole in our wallet. Literally. We just don't know how to spend our stimulus checks. Wow, that was a big one. But that's gonna give us a false sense of security, like, oh great, the economy's recovering, everything is great. But at the end of the year, when the debt comes due, when the forbearances come due, when everything is no longer peachy and we don't get those unemployment benefits, then we're gonna start to see a different story. Now, of course, instead, the stock market could go way lower far sooner, but that will depend on what's about to happen with China. So pay really close attention to that because the stock market hates uncertainty. Oh, look at me, I've covered all of my bases like Jamie Dimon. But if I am wrong, I'm going to be wrong on my timing, which right now I'm saying we're gonna feel it at the end of this year to the beginning of next year. That's when we'll see the real decline. Now for the super interesting part to make sense of all of this progress. Now I started actually keeping track in 2015. So keep in mind, the progress that you're seeing is not only because of dividend growth, which is what companies are supposed to do in a healthy economy, which of course right now we're not in, but more importantly, it's because I was saving and being frugal and investing around $2,000 per month for about 5 years on a $50K a year salary to help me get to this point. So let me show you. In May of 2015, I received $102.99. In May of 2016, I was paid $222.96. In 2017, $239. In 2018, $337. And in 2019, $408. So you can see how quickly all of this ramps up. And in 2020, I was paid $423.91. I know that doesn't sound like a lot, but that actually represents 3.6% increase over last year's May. But just the fact that I'm making a positive return that's growing throughout everything that's going on in the world right now is very encouraging. Still though, I'm not gonna get too excited because as we go forward in the year, some of those months may be lower than last year's months. But the most important thing to remember throughout your investing career is that saving your money is far more efficient than actually investing it, which is such a weird concept. But the more money you can save, the less you can spend, the less money you'll need in retirement, which means the less you'll have to work at your 9 to 5, which means the quicker you can actually get to retirement, like I'm trying to do with dividends. Believe it or not, you just need to let the magic of compound interest take over for you and do the heavy lifting and just make you a multi-millionaire over time. But if you're looking to get started with investing, go ahead and create an account with Webull. You'll get one free stock valued up to $250, and if you fund that account $100, you'll get another free stock valued up to $1,400. Get a third free stock by signing up for free with Robinhood. That's 3 free stonks to get you started with investing. Please follow me on Instagram. I post there from time to time. And guys, 2020 has been crazy. It's like, but wait, there's more. But regardless, I hope you feel a little bit happier. Thank you so much for spending a few minutes of your day with me. I hope I put a little bit of a smile on your face, and I would love to see you back here on Monday and Friday. Thank you so much, and I'll see you soon. Bye-bye.
Do just what you want. You're the one I trust.